Hello everybody and welcome back. This is Swati Gupta, Chartered Accountant. Today we are going to discuss how exactly the equity instrument investments are recorded as financial asset, initially as well as subsequently. How business model is tested for such types of investments, okay? And how does it impact PL and other comprehensive income? Also, we'll be using a very simple example in order to understand the final impact on our PL and OCI. Okay, so let's begin. Firstly, whenever there is investment in equity instrument, this is your financial asset. Now, here you have to check business model. Business model test. This is nothing but simply you have to check your intentions of the purchase. The investments that you have made, what is the purpose behind it? What are the intentions behind it? Firstly, for example, it is held for trading. That means those are just invested in order to take the benefit, take the gain of the value changes. Okay, so these are known as held for trading. You have no intentions to hold it till maturity. You have purposes, you have intentions to just take the benefit, take the gain of the changes in value and then withdraw it as soon as you find it profitable. Okay, good. This is known as held for trading. Now, next comes not held for trading. This is like that once you have made an investment, you have no intention to withdraw. It's irrevocable. It is also known as irrevocable. Okay, you have no intentions, no plans, no purposes to withdraw it. There is a binding agreement and arrangement while you do such type of equity instrument investments. Okay, now firstly you have to check, step one is to check business model. What is the purpose behind it? Now, how does it vary? Initially, when you have to record in books, if it's not held for trading, you have to record fair value plus transaction cost. While these types of investment, there are multiple brokerages, securities transaction tax, and other types of costs that are held, that are incurred in such investments. Okay, so such are known as transaction cost. These types of costs are known as transaction costs. Now it is said that such fair value and transaction cost should be recorded in balance sheet. Entirely, it should be recorded in your balance sheet. Okay, in your statement of financial position. Got it right? Good, great. Now, in case if it is held for trading, then record, please record fair value in balance sheet and record the transaction cost. Record the transaction cost in PL. Okay, it is said that if it is held for trading, please record only the fair value in balance sheet and the transaction cost will be taken care, will be recorded into the P&L. It won't be added and recorded and shown as a carrying amount in the balance sheet. Okay, now subsequently in the next reporting dates, what happens? Again, you have to calculate and record at fair value and the fair value changes will be taken care, will be shown through other comprehensive income. Whereas here, if we talk about held for trading, here also you have to record at fair value. But the difference due to fair value will be shown through PL, will be shown under PL. Okay. Now, as you know, other comprehensive income and PL. Other than this, the fair value, if you talk about fair value, this fair value is always recorded, is always calculated as per IFRS 13. IFRS 13 says how to calculate fair value and the specific standards describe and prescribe when to fair value. Okay, how to fair value is always done as per the IFRS 13. Okay, if you're clear with this, let's take an example. Example, ABC company is preparing its financial statement for the year ending 31st December 2008. Great. At 1st January 2008, the carrying amounts in equity instrument is 16.8 million. They have a financial asset which is investment in equity instrument. So you need to check the business model, whether it is held for trading or not held for trading. Okay. Now it is said that investment in equity instrument. That is how much? That is $16.8 million. Okay. Now you have to check the business model, whether it is held for trading or not. Not held for trading. That is irrevocable arrangement, binding arrangement. Held for trading, only change in value gains is the intention. Held for trading. Okay. Now it is said that let's see what happens in initial recording. What happens subsequently? Okay. Now under not held for trading, these include 9.6 million shares held for trading. That means $9.6 million has been recorded as held for trading. This is an amount that is shown into the balance sheet as a carrying amount of this particular investment in equity instrument. And 7.2 million for this is for which irrevocable election has been made. That is 7.2 million. Okay. Great. Now at 31st December 2008, all equity instruments were still held with the entity. That means there has been no selling out. These are still lying with the company entity itself. These shares held for trading had a fair value of 8.7 million. Okay. Whereas other shares that are not held for trading has a fair value of 8.6 million. Okay. Now let's see what is the gain and loss. Its impact. Let's see its impact. Impact. Now, as you know, here initially it was 7.2. Now your investments, now your financial asset has increased. That means there is a gain of how much? Of $1.4 million. And this should be taken to other comprehensive income. Whereas here, initially the carrying amount of the financial asset was 9.6. Now subsequently it has reduced, that is 8.7. This means that there is a loss of how much? Of $0.9 million. And it should be taken to PL. Are we clear? Now let's see how it is shown in your statement of PL and OCI. Now, as you know, the simple statement of PL and OCI has a PL heading as well as has a OCI heading. PL has its own incomes, own expenses, own taxes, and then a profit after tax is calculated under PL. Similarly, other comprehensive income has its own income items, own revenue, own expense items, own taxes. Okay, and then finally, a figure, income or expense or last profit is calculated as per OCI, other comprehensive income. Now, as you add your PL plus OCI, when you add your PL plus OCI, you get total comprehensive income. Now, since we have a loss of 0.9 million, how will it be shown? Where it will be shown? In your statement of PL and OCI, it will be shown loss on fair valuation of investment in equity instrument. How much? 0.9 million. It will be shown under PL. Whereas if we talk about gain, gain will be shown under OCI. Gain on fair value of investment in equity instrument, and it is 1.4 million. Are we clear? I hope this information simplifies and clarifies your concepts. Okay, in order to get the entire course, or you want to get information, you want to learn in Hindi language, then yes, the same video is also recorded in Hindi language. Okay, you can check the playlist. It is available on the channel. Also, if you are interested in learning entire IFRS, entire Ind AS in this in simplified manner using some important examples, then yes, don't forget to check out description box. The link to download app and get access to such very good, high, valuable courses are available. Okay, see you in the next video. Till then, take care. Be safe.